So as the tax codes have gotten a lot more complicated over the years, we get routinely asked about different tax strategies. Some are more complex and some are more simple. But one of the ones that seems to be most common amongst people that get close to retirement or in retirement is, what is the difference between long-term and short-term capital gains tax on stocks or mutual funds? It's really not that complicated, pretty simple to understand. And there's a couple of things that you can do to potentially reduce some of the taxes that you may pay on stocks that have appreciated over time. Now, there's no free lunch with taxes, so you are going to pay taxes if you have a gain on a stock. And we always tell folks having a gain out of stock is not necessarily a bad thing. But let's start with the basics. So short-term capital gains tax on a stock, for example, is a stock that you've owned that's appreciated in value that you've owned for less than 12 months. If you've owned a stock for less than 12 months and you decide to take a gain and actually sell that stock or part of that stock or some of those shares, then you're going to be taxed at whatever your ordinary income tax rate is. So for example, if you are a higher income earner, you could be taxed as high as 37% on a stock that you've owned less than 12 months. Is that the right thing for you? Well, that depends on your situation, but you definitely want to take into account what your current tax bracket is and whether or not you want to absorb or you're able to absorb, or the best strategy for you is to absorb a short-term capital gains tax. Now, conversely to that is long-term capital gains tax. Now, long-term capital gains tax is for stock or mutual fund or position that you've held for more than 12 months. So if you've held, for example, a stock for more than 12 months, depending on your income tax, that does play into this as well, but the tax can be less. So in that same example, if you were a higher income tax or income earner and you sold a stock that you've had for over 12 months, you could pay 15 or 20% versus 37%. Some people that are in lower income tax brackets actually pay 0%. So the bottom line is long-term capital gains tax is something you've owned for more than 12 months. Short-term capital gains tax is something you've owned less than 12 months. How does that apply to you? Well, that depends on your income tax bracket and what your overall goals are. Now, one of the other strategies that you can deploy here, if, for example, you're in a higher income tax bracket, is you can deploy what we call tax loss harvesting. And what tax loss harvesting allows you to do is to take a stock that you've had a gain on and then sell a portion of that where it's suitable and appropriate against a stock that you've owned in that same time period, or maybe short-term capital gains tax that you've had a loss on. So in other words, you can take a gain and take a loss against that gain and reduce some taxes that way. So really, when you talk about this whole subject of taxes, whether it's taxes relative to short-term or long-term capital gains tax or just taxes in general, it can get really complicated, and you want to make sure that you're sitting down with an advisor that's going to look at all components of your current situation. Income taxes, what you're paying as a taxpayer, what your potential is, are you doing things like Roth conversions? There's just a lot of variables that could play into this, but I will tell you the difference between having a really good, sound tax strategy on your investments can be immense. So if these or questions like these are things that you'd like more information on, contact our firm. We'd love to get this information into your hands. Thanks for watching, and hit the subscribe button below.